Alright, let's dive right into the fascinating world of finance with a book that promises to simplify one of the most complex markets out there, Forex. Today, we're exploring Simplified Forex, A Beginner's Guide to Success in the Stock Market, by Kel Butcher. This book is a perfect starting point for anyone interested in the Forex market, offering insights in a language that's easy to understand. Forex, or foreign exchange trading, is one of the largest and most liquid markets today. With roots tracing back to the Middle Ages, where trade began with precious metals like gold and silver, Forex has evolved into a digital platform. Kel Butcher takes this complex world and breaks it down into simple, digestible pieces, introducing readers to the dynamics of the Forex market. The significance of this book lies not only in explaining how the market operates but also in providing tips on becoming a successful investor. It highlights the risks associated with tools like leverage and how to navigate the market securely. Historical turning points like the Bretton Woods Agreement and the Nixon shock are crucial in understanding the current structure of the Forex market. If you're curious about foreign exchange trading or want to deepen your knowledge in this area, Simplified Forex is just for you. Let's embark on this journey through the captivating realm of finance together. This market, accessible to everyone, is filled with new opportunities and risks. Ready to dive into the details? Let's get started. Now, let's talk about the author and the context behind the book. Kel Butcher is an experienced investor and writer based in Australia. With over 20 years of experience in the finance world, Butcher has penned numerous books to share his knowledge and experiences with readers. Simplified Forex stands out as a practical guide for investors interested in currency markets but hesitant due to their complexity. Published in 2009, the book came out at a time when the global financial crisis led investors to seek alternative investment tools. During that period, currency markets offered significant opportunities but were also fraught with high risks. Butcher aimed to help readers better understand and manage these risks. By simplifying complex currency concepts, the book presents them in a language that even new market entrants can grasp. The historical roots of currency trading date back to the Middle Ages. Traders conducted transactions using gold and silver, and over time, systems like promissory notes and the gold standard were developed to make trade more practical. This historical process shaped the current dynamics of currency markets. Events such as the Bretton Woods Agreement and the Nixon shock contributed to the liberalization of currency markets and a significant increase in liquidity. Today, thanks to online platforms, retail investors have the opportunity to trade in these vast markets. Kel Butcher's book is an important resource for those interested in currency trading. The information it provides about the historical development and dynamic structure of currency markets helps investors make more informed decisions. By explaining the basic principles of currency trading in an understandable language, Butcher enables readers to navigate this complex market more comfortably. In conclusion, Simplified Forex is an indispensable guide for those looking to venture into currency trading. Welcome, dear listeners. Today, we're going to share the main ideas of the book, Simplified Forex. Kel Butcher's work helps us understand the building blocks and historical development of Forex trading. I'm here to explain how currency trading has evolved from the Middle Ages to become the enormous market it is today. Ready? Let's begin. The roots of currency trading go way back. In the Middle Ages, traders usually conducted transactions using gold or silver. However, transporting these precious metals was quite cumbersome. Therefore, a system of transferable promissory notes was developed, making transactions more practical. The cumbersome nature of gold and silver led people to seek ways to facilitate trade, leading to the emergence of the gold standard. The gold standard aimed to provide stability in the currency market by pegging the value of currencies to the price of gold. For instance, the British pound was fixed at 4.2472 pounds per ounce of gold, while the US dollar was pegged at $20.67. This allowed currency exchange rates to operate in a certain order. The gold standard created a secure environment for currency trading. However, it's worth noting that while this system limited inflation, it could also lead to high unemployment rates. So, stability was sometimes seen as a barrier to economic growth. The current dynamics of currency markets are shaped by these significant historical developments. Today, thanks to online platforms, retail investors have the opportunity to trade in these vast markets. However, understanding the risks posed by tools like leverage is key to becoming a successful investor. Leverage can amplify potential profits but can also multiply losses. One of the significant milestones in the Forex world began with the Bretton Woods Agreement. This system aimed to provide stability by pegging countries' currencies to the US dollar after World War II. However, the system began to collapse in 1971 with the Nixon shock. President Nixon removed the convertibility of the dollar to gold, moving to a floating exchange rate system. This led to the liberalization of currency trading and a significant increase in market liquidity. Now, the value of money changes based on market conditions, making currency speculation more attractive. The abandonment of the gold standard also led to a transformation in foreign exchange reserves. Countries began to prefer currency reserves over gold. For example, currencies like the euro and Japanese yen are seen as safe havens today, offering important alternatives for investors. The dynamic structure of currency markets and the floating system continue to present new opportunities for investors. Currency markets are at the heart of today's economic dynamics, and their growth has been made possible by the convergence of various factors. The establishment of the European Monetary Union and the introduction of the euro increased economic integration among member countries, leading to a boom in currency trading after the transition to floating rates. For example, the average daily foreign exchange volume has risen from $5 billion in 1978 to $4 trillion. This tremendous increase shows how much currency markets have grown. Fluctuations in interest rates directly affect exchange rates. A country with high interest rates usually sees its currency appreciate. For example, high interest rates in Turkey may increase the appeal of the Turkish lira. At the same time, the increase in international trade and the need to hedge against currency risk led companies to engage in currency transactions. This resulted in unprecedented growth in the currency market. Automated trading systems and the conveniences provided by the Internet have also made currency trading more accessible. Now, even small investors can take advantage of instant price changes. This increases market liquidity while enhancing the dynamism of currency markets. As a result, currency trading has become an accessible field for everyone today. Different currencies and their effects also play a significant role in currency trading. While the South Korean won holds an important place in the currency basket, other currencies such as the British pound, Russian ruble, and Australian dollar are also included. Particularly, the yuan's fluctuation within a narrow band determined by the People's Bank of China is critical for China's trade strategy. This deepens trade tensions with the US, as the US argues that the yuan should be devalued. The euro was accepted as the official currency of the European Union in 1999 and is used in 16 of the 27 member states today. The euro is the second most traded currency globally, and many countries with weaker economies seek stability by pegging their currencies to the euro. This not only prevents inflation but also increases the confidence of foreign investors. The Japanese yen stands out as the third most traded currency after the US dollar and the euro. Although post-World War II economic turmoil led to a devaluation of the yen, it is now considered a safe haven currency. For example, during international crises, investors often turn to the yen. This increases the yen's liquidity in the currency market and allows it to be traded in various currency crosses. The Australian dollar is also a commodity-based currency that holds an important place in the currency market. The country's economic stability, trade with Asian countries, and high interest rates increase interest in the Australian dollar. Especially, mineral exports are among the main factors driving demand for the dollar. For example, a rise in commodity prices worldwide increases the value of the Australian dollar, while a decline in these prices negatively affects the dollar. In times of economic uncertainty, investors often turn to currencies known as safe havens. In this case, the Australian dollar may lose value against more stable currencies like the US dollar. Additionally, the Australian dollar tends to show high volatility, making it attractive for currency trading. For example, strong resource demand from major economies like China has had a positive impact on the Australian dollar. Central banks play a critical role in ensuring economic stability in currency markets. Rising interest rates generally lead to an increase in the value of a currency. Low interest rates, on the other hand, weaken the currency. For example, when a central bank conducts foreign exchange purchases or sales through open market operations, it leads to the creation or destruction of new money in the market. This process directly affects the money supply in the economy. Central bank interventions in foreign exchange markets are a frequently used method to maintain the value of currencies. Naked intervention affects the money supply through direct buying and selling, while sterilized intervention attempts to balance these effects. These strategies of central banks are vital for maintaining stability in the markets and provide important signals for currency traders. Futures and swaps are also quite important in currency markets. Futures offer the commitment to buy or sell at a specific exchange rate on a specific date. For example, an exporter can minimize currency risk by fixing the payment they will receive in the future today. This protects them from unexpected fluctuations. Swaps allow the exchange of currencies between two parties and are typically used by large banks and companies. For example, if an Australian company borrows in euros while a French company borrows the same amount in Australian dollars, the two parties can swap to optimize their costs. Such transactions help reduce the risk of currency fluctuations and maintain the financial stability of companies. Finally, the spot market is a place where exchange rates change instantly. Here, transactions between two currencies usually occur within seconds. For example, when a company buys goods from abroad, it is quite common to transact in the spot market to avoid losses due to exchange rate fluctuations. The main feature of the spot market is that it provides settlement within 2 days, allowing investors to make quick decisions. And that's it. The world of Forex is vast and complex, from its historical roots to modern trading techniques. I hope this section has been helpful for you. Thank you for listening. See you in the next section. Goodbye. Here are 5 key lessons from the book that you can apply to your life. 1. The nuances of using leverage *. Leverage is an indispensable tool for investors in the Forex world. However, it's important to understand that this tool presents risks as well as opportunities. Leverage allows you to take large positions with a small investment, but it can also amplify your losses. Therefore, you should be cautious when using leverage and apply risk management strategies. For example, if you're trading with a 1:100 leverage ratio, even a small movement in the market can significantly impact your investments. That's why it's recommended that investors adjust leverage ratios according to their risk tolerance and always use a stop-loss order. 2. Understanding market dynamics *. The Forex market is directly affected by global economic and political developments. Therefore, to succeed in the market, it's necessary to closely follow global economic data and events. For example, an increase in a country's interest rates typically strengthens that country's currency. Similarly, political instability can lead to a currency's depreciation. Before entering currency trading, understanding these dynamics and being able to conduct market analysis will help you make strategic decisions. 3. Emotional control and discipline *. Emotional control is key to success in currency trading. When sudden fluctuations occur in the markets, it's important to remain calm and stick to your predetermined strategy instead of panicking. Discipline requires acting rationally and planned rather than emotionally. For example, instead of making hasty decisions to recover your losses, it is healthier to reanalyze the market and stick to your strategy. This approach will allow you to become a more stable and successful investor in the long run. 4. Combining technical and fundamental analyses *. To be a successful Forex investor, you must be able to use both technical and fundamental analyses effectively. Technical analysis usually involves examining price charts and historical market data to predict future price movements. Fundamental analysis, on the other hand, evaluates factors such as economic indicators, central bank policies, and political developments. By combining both types of analysis, you can gain a more comprehensive market view and make more informed investment decisions. For example, when a country's economic data is strong, you can better understand the impact of these data on price charts through technical analysis. 5. Continuous learning and development ***. The Forex market is a constantly changing and evolving structure. Therefore, to succeed in the market, you must be open to continuous learning and self-improvement. Learning new strategies, keeping up with market trends, and discovering different analysis methods will help enhance your investment skills.